In many ways, the financial system is a little bit like an anesthesiologist. Nobody much notices the job they're doing until something screws up.
Hello and welcome to GZERO World. I'm Ian Bremmer, and today I'm sharing some tips and some tricks for how you, yes you, can be first in line at your next local bank run. I'll demonstrate the proper way to stuff all your cash under your mattress without making your bed lumpy. Lower back pain is real, my friends. Just kidding. But we are going to talk about the recent bank failures that have roiled global markets and spooked investors from Silicon Valley to Switzerland. I'll look at how we got into today's banking mess, whether or not it should be called a banking crisis, not really, and how much more financial turmoil we can expect. And I'll be joined by inflation whisperer and former U.S. Treasury Secretary Larry Summers. But first, there's talk of another surge. Walk the city sidewalks of London, New York, or San Francisco, you'll catch the same nervous chatter. The contagion is spreading. The authorities don't have the outbreak contained. We've been here before. I'm talking, of course, about banking. So why am I triggering your pandemic PTSD? In part, because if I start off the show saying stuff like illiquid investments or capital leverage, you're going to change the but also because so much of what's driving today's banking drama, resulting in the most significant government intervention this side of the Great Recession, is a virus that's even more contagious than COVID. Panic. Here's what happened. The U.S. government's Federal Deposit Insurance Corporation, or FDIC, provides insurance up to an amount for depositors in case their bank fails. The up to an amount, by the way, is important. On March 10th, the FDIC took control of the major tech lender Silicon Valley Bank, or SVB, to stave off a $42 billion bank run. SVB customers, many of whom had far more than the FDIC insured limit in deposits, they all wanted their money out immediately. The move signaled the biggest banking collapse in the country since WAMU, Washington Mutual, failed in 2008 and panicked the markets. 2 days later, the FDIC shut down a second U.S. regional lender, Signature Bank, following a run on its deposits by customers who were alarmed by SVB's implosion. And as the panic spread across the Atlantic, shares at Switzerland's second largest bank, Credit Suisse, tanked by 30%. On March 19th, Switzerland's biggest bank, UBS, agreed to buy its little banking brother in an emergency deal intended to calm the global markets. That didn't happen. Meanwhile, back in San Francisco, spooked customers of another major regional lender, and for full disclosure, our show's founding sponsor, First Republic Bank, were rushing to withdraw their deposits. The urging of U.S. Treasury Secretary Janet Yellen, J.P. Morgan Chase CEO Jamie Dimon organized an infusion of $30 billion from 11 of the nation's biggest banks into First Republic Bank's deposits. The message to customers from the public and the private sector was the same: do not panic. Only time will tell if the aggressive public and private intervention will be the vaccine that contains the panic virus, or if what we have seen so far is the first of many waves to come. If you're not hiding under your couch, here's what you might be asking. Why did Silicon Valley Bank fail in the first place? What role did inflation play in the whole mess? Is capitalism broken? Here to help me tackle those not at all panicky questions is inflation whisperer and former U.S. Treasury Secretary Larry Summers. Larry Summers. Larry, good to have you back.
Good to be back, Ian.
So much to talk about. I want to start with the banking crisis and ask you to explain just for a moment to our audience why these two banks have failed, Silicon Valley Bank and Signature Bank.
Like any big accident, there are multiple causes. The first is that we now live in a digital world with high interest rates. And that means that people are going to be much more reluctant to keep their money in places that are paying them zero interest rate when they could get 4 or 5% interest somewhere else. And they're going to be much more quickly moving to adjust, particularly if they become alarmed about whether they're going to get their money back. That's the first part. The second part is that the banks that held these accounts invested their money in assets that went way down in value. They made risky loans, and much more importantly, they invested in long-term bonds. And when interest rates went up, the value of those long-term bonds went down. So depositors looked around and they saw that the assets backing their deposits were going down in value. They saw that it was easier than ever before to move their money somewhere else. And they saw that they could get higher returns elsewhere. And they saw that because of digital procedures, it was easier to open accounts elsewhere. And all of that came together to cause massive withdrawals. And just as 100 people all trying to get out of a theater at the same time in a big hurry would cause the other 1,000 people in the theater, even if they didn't really know what was going on, to try to rush out as well. That kind of mob bank run psychology took over at these banks. And then we had the situation that we did of a mass run that required the government to step into the situation.
Who has acted most irresponsibly around this?
It's a race. There are a variety of candidates, but I would say the gold medal for incompetence goes to the management of SVB, which grew its deposits at a spectacular rate, didn't have a chief risk officer for 9 months, ignored a multiplicity of warnings about its interest rate mismatch, didn't engage in the most basic kind of bank planning that junior analysts are taught, and had the hubris to regard itself as a heroic, worthy institution. I think the silver medal for incompetence probably goes to the Federal Reserve System in its regulation of Silicon Valley Bank and beyond, because that regulation didn't stop this accident that was waiting to happen. And the authorities had plenty of authority to have forced it to raise capital much earlier, to have stopped it from paying dividends, to have forced it to interest rate hedge, to have done a whole variety of things. The progressive critics are right that almost everything in the Trump era legislation that Congress passed, moving to lighter touch regulation, was misguided.
On not the biggest banks. This was on like the medium-sized
on the medium-sized bank.
Yeah,
that was bad.
right.
That was bad, misguided legislation.
For most of the people that are watching this right now who don't have money directly at stake, why should they care?
They have a stake in the broad economy. And when there are challenges to the banking system, that affects the flow of credit, which affects everything from their mortgage to the financing of the inventory at the stores where they shop, to the ability of their employer to get credit. You know, in many ways, the financial system is a little bit like an anesthesiologist. Nobody much notices the job they're doing until something screws up. And then it becomes highly salient and highly visible. And that's what happened for people who were worried about meeting payroll at SVB a couple of Mondays ago. And that's why we regulate and insure financial institutions so that people can go about their business without worrying about whether they're going to be major failures.
So let me turn for just a couple of moments to the policy response so far. I guess one question I'd want to ask is how do you rate Biden administration, Yellen, Fed
I think on the positive side, the decision to guarantee the depositors at SVB was very much a proper action, and to have not taken it would have been to have courted substantial risks. I was not so enthusiastic about the way the SVB bailout has been handled. $20 billion of, and let's face it, banks aren't people. When banks pay taxes, people ultimately pay taxes and fees. So $20 billion for the resolution of FDIC, of SVIB, seems like an extraordinary sum, and I wonder if that couldn't have been done considerably more inexpensively. I'm concerned that there's still too much ambiguity out there in the system about what will happen to uninsured bank deposits. And I wish there were a bit more stepping back to think about the final set of developments. Looking across the economy right now, I'm probably particularly worried about real estate, and within real estate about the office building sector. I've got considerable apprehensions about corporate lending to mid-sized businesses, the activities that were heavy areas of emphasis for regional banks are, I think, particularly problematic.
Isn't it surprising that commercial real estate hasn't blown up, given the fact that the biggest change, in the economy in the U.S. post-pandemic is the fact that people just aren't going directly to their places of work the way they used to?
Remember, Ian, that only about 20% of commercial real estate is office buildings. Remember also that if people come to work 3 days a week, that doesn't mean I only need 60% as much space as I did when they worked 5 days a week, because I need to have the capacity to accommodate them all on the days when they're all coming in order to be together.
I want to ask you some other global questions. Don't not take all of our time about the banks, since I have you here. One, I know you're not an AI expert, but we're all talking about it, and I'm wondering if you were Treasury Secretary right now, and you saw coming this AI explosion, what would you be watching for in terms of impact on jobs, impact on productivity in the United States? I mean, are you yet seeing anything that makes this feel truly transformative from an economic perspective?
Things happen slower than you thought they would, and then they happen faster than you thought they could. A good example of that is driverless cars. 6 or 7 years ago on shows like this, we would have been confident that they were going to be transforming the taxi and chauffeur industry by now, but they've really had almost no effect yet. Sooner or later, they will. And I think there are many examples like that. So I suspect there's going to be less impact than many people fear in most sectors over the next 3 years, and more impact over the next 10 or 15 years. For example, my guess is that AI will change what doctors do, diagnose people on the basis of complex information, sooner and harder than it will change what nurses do, giving people basic medical treatments and giving them comfort and compassion. So I think there are a lot of traditional hierarchies and ways of thinking about the way organizations work that's likely to be quite profoundly changed here.
I've got two more topics I want to ask you about quickly. One, on Russia, I've seen you talking a little bit about the idea that the frozen assets of Russia should be seized to help rebuild Ukraine. And I wonder, I've heard from Europeans that they think that that's legally not doable. And of course, also, if it is doable, it also leads to the possibility that these sorts of levers can be used against other countries, potentially freezing investments and causing unexpected knock-on consequences. Wondering your thoughts there.
So this is a rare case where the right thing to do and the expedient thing to do are the same thing. As between American taxpayers paying for Ukraine and Russia, which has a debt to Ukraine, having, for all the damage it has done, having its collateral on that debt, namely the frozen Russian assets, seized, it seems to me very clear that the assets are the better means of supporting Ukraine. What I'm told by pretty authoritative lawyers is that the legal claim here is very strong. These are assets that are already frozen. Frozen assets in the context of the Iraq War were used for this purpose. Certainly, Russia has seized any number of foreign assets that are currently located in Russia. Russia certainly didn't have any compunction about German or Japanese assets in the context of the Second World War. So I think the legalities here are actually very clear. And if we set a precedent that countries that engage in such wanton aggression that their heads of state are labeled as war criminals, that the official state assets of those countries are going to be used to mitigate the damage that their aggression caused, that feels like a very good precedent to set in the world. And I don't believe that that's going to point towards the seizure of our country's assets. And even if it did, we don't have any significant level of foreign reserves that are currently held abroad.
Larry Summers, thanks so much for joining.
Thank you.
That's our show this week. Come back next week, and if you like what you see, or even if you don't, but you want more bank runs, who doesn't? More bank runs, more cowbell, we have that for you. Take a minute to sign up for our most excellent morning newsletter. It's called GZERO Daily.